Welcome back to the Pro Ticker Podcast. Today, you know those dividend stocks that you always hear about, like the ones you can just buy and like tuck away in your portfolio? Well, those forever stocks are exactly what we're diving into today. And what better guide than this article from U.S. News and World Report? Is called Seven Dividend Stocks to Buy and Hold Forever. And then that was published pretty recently on October 8th, 2024. Now, the article leans pretty heavily on analysis from Argus analysts. And they've picked out some really interesting companies, like household names, the big players, the ones with, the potential for stable growth and reliable income. So let's get into it. Right off the bat, the article kind of reminds us about how powerful these dividend stocks can be. It says over the past 90 years, dividends have accounted for roughly 40% of total stock market returns. I mean, wow, that's pretty impressive when you think about it. Nearly half the market's returns coming from those consistent payouts.
Yeah, it's really something. For almost a century, through good times and bad, dividends have just delivered the significant chunk of the market's gains. It really shows you why a long-term dividend-focused approach can be so powerful, when you're trying to build wealth.
Exactly. And to really illustrate this power, that the article presents seven dividend stocks, handpicked by Argus analysts as those potential forever holdings. We've got the ticker symbol, the current dividend yield, and Argus's estimated upside potential for each company. Ready to see who made the cut.
Yeah, let's jump in.
All right, so first up, it's a name you'll definitely recognize, J.P. Morgan Chase & Co., ticker symbol JPM. They're currently offering a 2.4% dividend yield, and Argus sees a potential upside of 11.4%. Now, remember earlier this year when J.P. Morgan acquired First Republic Bank during that whole regional banking crisis? Well, analyst Stephen Bigger actually sees that as a positive for J.P. Morgan's long-term prospects.
Yeah, it's interesting how this acquisition could really solidify JP Morgan's position in the banking world, I mean.
Right.
By absorbing First Republic's assets and clients, JP Morgan gains more market share, strengthens its competitive edge. Of course, any big acquisition comes with some risks, but Bigger seems pretty confident that JP Morgan can handle those challenges.
Yeah, that makes sense. Bigger also pointed out J.P. Morgan's credit card business and lending growth
Yeah.
as a key factors in his bullish outlook. He thinks the company is in a good spot to capitalize on the current economic situation. Now let's switch gears a little bit. Let's head over to the world of home improvement. With Home Depot, ticker symbol HD, they're offering a 2.2% dividend yield right now. But the analyst covering them, Christopher Graja, he acknowledges that Home Depot is facing some headwinds due to those higher interest rates. I mean, it makes sense that people might not be jumping into those big renovation projects right now.
Yeah. I mean, this is a classic example of how the bigger economic picture can affect specific industries. When interest rates go up, it makes big purchases more expensive. And that can definitely cool down sectors like home improvement.
Right, but here's where things get interesting. Graja points out that a lot of U.S. homeowners, around 75% actually, have those mortgage rates locked in below 4.5%. And they're way more likely to invest in home improvements rather than selling and having to deal with those higher rates on a new mortgage.
Yeah, that's a really good point. It's like a silver lining for Home Depot in this whole interest rate situation.
Hmm.
Those homeowners who are basically stuck with their low mortgage rates might see home improvement as a better option than moving. And that could mean a lot of business for Home Depot.
Exactly. And on top of that, Home Depot bought SRS Distribution, a trade distribution company, which gives them even more ways to grow in the long run. So even with the challenges ahead, there are reasons to be optimistic about Home Depot. They could definitely weather the storm and keep rewarding those investors. Now let's talk about a company that's like a staple in our lives. I'm talking about Procter & Gamble, ticker symbol PG. You probably have a bunch of their products in your house right now. Pampers, Tide, Gillette, I mean, the list goes on and on. And they've got a solid dividend yield of 2.4%. Analyst Taylor Conrad is really impressed with how P&G is handling inflation. Even with the rising costs, they've managed to raise prices and expand profit margins.
That's what we call pricing power in action. Think about it when you're at the store. Are you going to switch to the generic laundry detergent? Or are you going to stick with the Tide you've always used? Companies like P&G, with those big brands and loyal customers, they can adjust prices without losing a ton of market share. And that pricing power is a big advantage during times of inflation.
So even when the economy is a little rocky, P&G can stay profitable and keep delivering value to those shareholders. Next up is another household name, Johnson & Johnson, ticker symbol JNJ, with a 3.1% dividend yield. But what's really cool about Johnson & Johnson is that they're a dividend king. They've increased their dividend payments for at least 50 years in a row. And get this, Johnson & Johnson has actually done it for 62 years straight. It shows you how committed they are to rewarding their shareholders. Analyst David Tung is also optimistic about their pharmaceutical and medtech areas, especially with new drug launches and products getting ready for approval. Plus, they're looking at licensing agreements for advanced medical devices, which could be a huge growth opportunity in the future. Now let's talk Coca-Cola, ticker symbol KO, with a solid 2.8% dividend yield. They've been refreshing the world for over a century, but what's interesting is that they're not just about sugary sodas anymore. They've been branching out, like when they bought Costa Coffee a few years back.
Yeah, that was a smart move by Coca-Cola. It shows they're paying attention to how consumer preferences are changing. With more people focused on health, Coca-Cola is positioning itself to cater to a wider range of tastes.
Exactly. Analyst Taylor Conrad, who also covers Procter & Gamble, admits that Coca-Cola faces challenges in the beverage market, but he's confident they can use their iconic brands and adapt to stay ahead. All right, we've got two more companies left on our list. First is Merck & Co., ticker symbol MRK. They're a major player in pharmaceuticals, known for their blockbuster cancer drug Keytruda and the HPV vaccine Gardasil.
Yeah, Merck is all about innovation. They're always investing in research and development, getting more approvals for their drugs, and expanding their pipeline of new treatments. That focus on innovation helps them grow and stay at the top of the pharmaceutical industry.
Absolutely. And last but not least, we have Chevron Corp., ticker symbol CVX, a global oil giant with a history of rewarding shareholders.
What I like about Chevron is their dedication to those shareholder returns. Even with those fluctuating oil prices, they've consistently paid dividends. And they're in a good spot for growth thanks to new projects and acquisitions.
So there you have it, 7 potential forever stocks, each one a leader in a stable or growing industry, as the U.S. News article highlighted.
And that's a key takeaway for those long-term investors. You want companies that are doing well now, but also operating in sectors that'll be relevant and profitable for years to come.
We've covered a lot of ground here. I'm curious to know what stands out to you the most. Of these 7 companies, which one piques your interest? And what other research would you do before making any investment decisions? We'll continue our deep dive into these dividend-paying powerhouses after a quick break. Welcome back to the Pro Ticker Podcast. As we're looking at these 7 potential forever stocks, what really stands out is how many different industries they're in. We've got financials with JP Chase, consumer discretionary with Home Depot, consumer staples with Procter & Gamble and Coca-Cola, healthcare with Johnson & Johnson and Merck, and even energy with Chevron. This really reminds us about diversification, doesn't it?
It really does. When you invest in different sectors, it's like you're creating this safety net for your portfolio. So if one sector isn't doing so well, others might be thriving, which helps to balance things out.
Yeah, like they say, don't put all your eggs in one basket.
Exactly. And what's really cool about this list is that these companies are also connected to our lives.
Yeah, you're right. Think about it. You probably used a P&G product this morning. Maybe you got coffee from a place Coca-Cola owns, or filled up your car at a Chevron station. These aren't just random companies, they're part of our everyday lives.
Yeah, and that connection can make investing feel more real. It's about understanding what they do, seeing how they impact the world, and believing in their potential for the long term.
It's about having that conviction, right?
Exactly.
So let's take a closer look at a couple of these companies and see what makes them so interesting. We talked about JP Chase buying First Republic Bank, but there's something else I find intriguing about them. Their focus on technology.
Yeah, JP Morgan has been putting a lot of money into fintech. They know that the future of finance is tied to technology. They've been developing new platforms, streamlining things, and using data analytics to improve the customer experience and their own efficiency.
It's like they're combining the best of both worlds.
Right.
The stability of a big bank with the innovation of a tech company.
Exactly. And that's a powerful combination these days.
Now let's think about Home Depot for a second. We talked about those higher interest rates and how they could affect home renovation spending. But there's also this demographic trend that can help Home Depot. I'm talking about the aging population.
That's a great point. As baby boomers retire, they often focus on improving their homes, making them more comfortable and accessible, and that creates a consistent demand for what Home Depot sells.
So it's not just about looking at the numbers. You have to understand those bigger societal trends too.
Absolutely.
Now let's talk about a company that's practically synonymous with dividends, Johnson & Johnson. We mentioned their amazing streak of dividend increases. But what really sets them apart is how diversified they are.
Right. They're in pharmaceuticals, medical devices, and consumer health products.
So even if one part of their business struggles, the others can help pick up the slack.
Exactly. That diversification makes them really resilient, and that's appealing to those long-term investors.
And speaking of resilience, let's not forget Coca-Cola. They've been around for over 100 years. They've seen it all, economic ups and downs, changing tastes.
Coca-Cola's strength is their brand recognition. That logo is everywhere. And their products have this nostalgic feel that connects with people across
It's
generations.
like they've tapped into something universal.
Right, that desire for happiness and refreshment.
Yeah.
And that connection with consumers gives them a real edge.
All right, let's dive into the world of pharmaceuticals with Merck. Their cancer drug, Keytruda, has been a game changer, and they have a lot of promising new treatments in development.
Merck is all about pushing the boundaries of medicine, developing life-saving therapies. And that's both inspiring and financially rewarding. As the world's population ages and healthcare needs grow, the demand for effective treatments will only increase.
It's a sector with huge potential, both for growth and for making a positive impact. Finally, let's talk about Chevron, the energy giant. The world is definitely moving towards cleaner energy, but oil and gas will still be important for a while.
And Chevron is in a good position to navigate that transition. They're investing in renewables, but they're also making the most of their oil and gas operations.
It's a balancing act, for sure, but Chevron has the size, resources, and experience to handle it.
And they're committed to paying dividends, which makes them attractive to income-seeking investors.
So, as we wrap up our look at these potential forever stocks, what are the main takeaways for our listeners?
I think the biggest takeaway is that long-term investing is about finding companies that you connect with, companies with sustainable business models, strong leadership, and a vision for the future that you believe in.
It's about aligning your investments with your values.
Exactly. It's not about getting rich quickly. It's about building a portfolio of companies you can hold for years and letting those returns compound over time.
It's about investing with purpose and conviction.
Exactly. And remember, these 7 companies are just a starting point. There are tons of other potential forever stocks out there.
So do your research, explore different industries, and build a portfolio that reflects your goals and your risk tolerance.
That's right.
Welcome back to the Pro Ticker Podcast. So we've been talking about dividend stocks and those forever companies, the ones that could give you both growth and that steady passive income. And now it's time for some listener questions.
Yeah. Let's see what they've got.
All right, so the first question is, with interest rates going up, are dividend stocks still a good investment?
That's a good question. And a lot of investors are wondering about that right now. I mean, it's true that when interest rates go up, those fixed income investments like bonds can seem more attractive, at least at first glance. But dividend stocks still have a lot to offer. For one thing, they can help you deal with inflation. As prices go up, company earnings and dividends tend to rise too, so that helps protect your purchasing power.
Yeah, that's really important these days.
It is. And then there's the fact that dividend stocks can give you both income and growth. Unlike bonds, which usually have a fixed income stream, dividend stocks have the potential to increase their payouts over time, so you could see your income stream grow, and maybe even some capital appreciation as the stock price goes up.
So it's not just about those quarterly checks. There's that long-term growth potential too.
Exactly. And don't forget about diversification. When you include dividend-paying companies from different sectors in your portfolio, you're spreading out your risk and potentially lessening the impact if one company or industry doesn't do so well.
So even with interest rates rising, dividend stocks can still be a valuable part of a balanced portfolio. Here's another question from a listener. How can you tell if a company's dividend is sustainable? What are the things you should look for?
That's the million-dollar question, right? Well, there are a few key metrics and factors to consider. One of the first things to check is the company's payout ratio. That's the percentage of earnings that are paid out as dividends. Ideally, you want a low payout ratio, say below 60%. That means the company has some wiggle room to maintain or even increase its dividend. It's a sign that they're not overextending themselves to reward shareholders.
So it shows they're being responsible.
Exactly. Another thing to look at is the company's free cash flow. That's the cash they generate after taking care of things like capital expenditures. You know, the money they spend on maintaining and growing the business. If their free cash flow is healthy and growing, it means they have the financial flexibility to keep paying those dividends.
So they have enough cash to invest in their future and reward their shareholders.
Right. And of course, you got to look at their debt levels. A lot of debt can make it hard for a company to keep paying its dividend, especially if interest rates are going up and they're facing higher borrowing costs.
So a manageable debt level is a good sign.
Definitely. But it's not all about the numbers. You also need to think about the company's business model as a whole, their position in the market, and their long-term growth potential. If a company has a strong competitive advantage, a history of profitability, and a clear vision for the future, they're more likely to be able to sustain their dividend in the long run.
It's about looking at the big picture, the numbers, and everything else.
Exactly.
Okay, last question from a listener. What's your best advice for someone just starting out with dividend investing?
Hmm. Well, I'd say the most important thing is to have a plan. Spend some time figuring out your investment goals, how much risk you're comfortable with, and how long you plan to invest your money. Once you have a good understanding of those things, you can start researching companies that fit your goals.
So it's like having a roadmap before you start your journey.
Right. And don't worry if you don't have a ton of money to invest right away. You can start small and build your portfolio over time. Just remember, consistency is key.
Those small steps can really add up.
Exactly. And when you're picking companies, focus on quality over quantity. It's better to own a few shares of a well-run company with a sustainable dividend than to chase those high yields from companies that might not be so financially sound.
So do your homework and be selective.
Absolutely. And maybe most importantly, be patient. Dividend investing is a long game. You're not going to get rich quick. Just stay focused on your goals, reinvest those dividends, and let that compounding work its magic.
That's great advice. And to all our listeners out there, we hope this deep dive into dividend stocks has given you some valuable insights to help you on your investing journey. Remember, building a successful portfolio takes time, patience, and a willingness to keep learning. So stay curious, keep exploring, and keep seeking knowledge. Until next time, happy investing.